Good morning, everyone, and welcome to another session for Startup Chippewa Valley Week 2025. Really excited this morning to have Austin Preece of Preece Financial Services. We're incredibly excited to dig into some finance and tax foundationals for entrepreneurs. A couple quick comments about Startup Chippewa Valley. First and foremost, our mission is to educate, celebrate, and connect entrepreneurs, small businesses, and startups across the Chippewa Valley. We're really grateful to our sponsors, our community advisors, our programming hosts, and everyone involved making this year a success. This is going to be a live stream and a live recording, so we'll be taking audience questions at the end. And with that, I'll turn it over to Austin.
All right, thank you. Not very often that I hear that people are excited to talk about accounting and finance. I usually am, but I'm glad to hear that at least Ray is excited. Hopefully some of you watching are as well. So again, Austin Preece, Preece Financial Services. I'm gonna try to get my mouse working here. Oh, I have left the meeting. Wow. Man, good stuff. Yeah. All right, let's see. I think I better do that. Okay, thank you. Dancing is great for everyone. This is going to really cut into my 6-hour presentation here. Oh my gosh. It's really... Ooh. All right. We're getting there. This is the funniest start to a presentation I think I've ever had. Okay, laptop's going right here where I'm not going to screw anything up, hopefully. Okay, yeah.
So I think the only thing is you guys start presenting.
I got to start presenting. Yep. Here we go.
There we go. We're back.
Now everybody's really excited.
And with the recorded version, we'll cut here.
Yeah, perfect. Okay, yeah, so I'm excited to talk about accounting and finance for entrepreneurs today. It's really most of my life. You know, I work with what I call regular people too, the people who have regular jobs, but I like working with crazy entrepreneurs as well because I am one myself. So a little bit about what we're going to talk about today. First agenda point for me is always disclosures because I got to make sure that everybody knows that this isn't advice. There's a whole page for it. What I'm going to ask everyone to do is screenshot it so that you can read it later in detail. I'm just kidding, you don't have to do that, but I do have to show you. Then we're going to talk a little bit about my company and me. Some things to consider, I kept that vague mainly because I didn't have a good way to put that stuff into a category. Some bookkeeping basics, changes to the tax law that happened this summer, and then lastly, some stuff about investing for the future. So first, the disclosures, basically the main point here, I put it in bold and underlined at the bottom. None of this is advice. I don't know any of you, right? Well, I might know some of you, but I don't know your specific situation, so I can't give you personalized advice. And more importantly, I charge for that, so I can't just give you personalized advice for free, right? So, but hopefully you get some education out of this. This is all for educational purposes. So, a little bit about my company, Preece Financial Services. I started the company back in 2023. A little bit of my background personally. I went to school here in Eau Claire, graduated at the end of 2019, spent some time at a really large accounting and financial firm in the area, and then started my company. While I was at the firm that I was at before, I got my CFP credentials, that stands for Certified Financial Planner. Basically what it means is I got my degree in finance and then I went and took more classes about personal finance, took a big exam at the end and have some experience and pass ethics classes every year. So that's what that means. The EA behind my name stands for Enrolled Agent. That's a tax designation with the IRS. Basically means that I can represent taxpayers before the IRS, kind of like a CPA. So little bit about what we do. A lot of the focus is on financial planning. That's mainly personal financial planning. Really what that means is anything that you think might be related to financial planning, we're probably going to cover it. That'd be investments, insurance, estate planning, tax planning, planning for retirement, planning for maybe buying a house. I talk to a lot of people who want to build up rental property portfolios. All that type of stuff we build into financial planning. Also do tax prep and tax planning. So in the spring, we're going to be busy with tax prep season. We do individual returns as well as business returns. There are some returns that we'll turn away because they're not right for our firm, but if we are not the right fit for it, we'll find you someone who will do that return for you. We also do tax projections towards the end of the year so that people can understand what their tax liability is looking like for the spring, and if there's anything that we should do at the end of the year to mitigate that, and do some multi-year tax planning. And then the bookkeeping and payroll side of the business, really helping keep all of your books in order, making sure your employees are paid on time, or you yourself are paid correctly through payroll if you file as an S Corp. We're mainly doing payroll in the state of Wisconsin, so that's why I have Wisconsin tax on there. There's some specific stuff there we don't get into other states. And we file W-2s and 1099s for the businesses that we help out there as well. So that's enough about that. We're getting into that vague topic of things to consider with entrepreneurship. So first of all, I think it's really important, you got to have a good name, right? And like Michael Scott, a lot of times it's important to have multiple names so that if your business does go under, you can just start a new business under a new name. Pretty sure that's how that works. Thankfully, I haven't run into it yet. I have changed the name of my business, so I'm getting an A in that category. But that's an important piece. Make sure you watch The Office. A lot of good tidbits in there. So, and I'm sorry I can't hear you laughing. I'm sure everyone's laughing uproariously right now. When you start a business, it's really important to make sure you have a firm handle on your personal finances. And that means having a strong emergency fund, which when you start a business, we get to now call it a runway, because the more cash you have in the bank, the longer you can not make money to make your business succeed in the future and keep plowing money back into the business, right? So that's an important piece. It's really important to understand your personal budget and what you need for personal spending so that you know how much runway you have, right? And also how much money you need to make from your business in order to keep the personal lifestyle that you want to live. It doesn't hurt to have a backup plan or part-time income stream. When I started my business, I bartended for a little bit. I've always loved bartending. I did it all through college, and it was a great way to have a little bit of extra income while I was starting my business. I also had the benefit of having a wife who had a real job, so I get to just run around and do stuff like this, talking about personal finance. It's important to think about some insurance pieces, right? A lot of times starting a business, you're going to need probably some business insurance, so that's an important thing to think about. But the personal side of insurance as well, a lot of times we get our insurance through our places of work, so especially health insurance. That's something that we'll talk a little bit more about towards the end of the presentation. But important to make sure you have a plan for getting your health insurance. Think about your life insurance and what types of needs you might have there. And then disability insurance is a really big one. A lot of times we think about life insurance. Well, if I get hit by the proverbial bus tomorrow, what does my family need in order to continue living the life that they want to live, right? Disability insurance, you're much more likely to actually have some sort of disability event while you're working than you are to pass away. So there's sort of a higher risk there, and it can last a lot longer, right? So if you're in your 30s and something happens where you become disabled and you can no longer work in your job, that disability insurance can cover some income replacement until your 60s. So really important to have something like that in place. Also important to have metrics for your business, right? Understanding, again, at the top, the budget for your personal situation, tying that into what do you need the business to do in order to make the business work and make your personal life work together. So having some success and failure metrics and like, okay, if we're 3 years in and I haven't been hitting this metrics, do I need to pivot in the business? Do I need to pivot in my personal life? What are we going to do there, right? And then saving for retirement. You know, people are, if you've had a regular W-2 job before, you're probably used to saving in a 401k plan or something like it. We'll talk a little bit more about the options for self-employed people towards the end of the presentation. But important to be thinking about, you know, building assets outside of the business as well once you're able to do so. So, another thing to think about, entity structure, right? So I get a lot of questions about, hey, I'm starting a business. Do I need to set up an LLC? Or, you know, I'm starting a business. What do I need to do on the entity side of things? Really, technically, you don't need anything, right? You can just raise your hand, plaster a name on a piece of paper and stick it to your front door and say, hey, I've started a business, I'm selling widgets. There are, of course, some other certifications and stuff that some businesses need, but from a tax standpoint, you don't need an entity in order to start a business. So that would be a sole proprietorship. A limited liability company, really easy to set up. Another thing, another common entity. Generally, I tell people if you are going to start a business, it makes sense to file an LLC. A lot of people talk about S corporations. We're going to talk about S corporations a little bit more in a couple of slides here. And then partnerships are pretty common. You want to go into business with someone else. Often that's actually just an LLC that has multiple owners. So those are, I would say, the most common entities. A couple of the less common entities, C corporation and nonprofit. A C corporation is a completely separate entity from the owner. If you own any stocks, those are all C corporations. They pay their own taxes. Typically, it doesn't make sense for small businesses to start C corporations. There are a couple of situations where it might make sense, but not very common. And then nonprofits. Obviously, nonprofits are typically built for to have sort of a greater purpose. Not very common because, like when I started my business, you know, kind of the point is profits, right? That's part of the point of my business. That's not to say that you can't make money with a C corporation or a nonprofit. It's just they tend to get a little bit more complicated. So definitely need to loop some professionals in who know what they're talking about when you're looking at the more complicated types of entities. The more common entities here, these all affect the owner's tax return. So the profits from these, they all wind up on the owner's individual tax return. The less common entities don't affect the owner's tax return, except for you might be getting wages from one of those entities, and of course that would show up on your tax return if you own that company. But typically these are all going to wind up on your own tax return, and those aren't. So a little bit more, so sole proprietorships and SMLLC, that stands for single member LLC. Like I said, they're very simple. There really is no separate tax entity. Technically, there's a separate legal entity if you have an LLC, but as far as taxes are concerned, it's a disregarded entity. So it all shows up on your individual tax return the same way, whether you're a sole proprietorship or an LLC. That's a big misconception. People think that LLCs have some tax savings associated with them, and they can if you file the LLC as an S corp. Again, we'll get back to that. But typically, if you're just setting it up as a single member LLC, not going to change anything on your taxes. The really only difference is that with an LLC, you file with the state that you are in to have the limited liability company. So that's the main difference between the two. Partnerships, like I said before, they're often multi-member LLCs, so they're just LLCs that have multiple people who own them. It's a separate entity as soon as it becomes a partnership. So now you have a partnership tax return that you need to file. Those partnership tax returns are due on March 15th instead of the individual deadline of April 15th, because those have to be done in order to get your personal tax return done, because all of the profits flow through to your personal tax return. So it gets a little bit more complicated. If you set up a partnership, you're going to wind up paying more fees for tax prep. Owners are issued a K-1 as their tax form. So instead of 1099s or W-2s, you're going to get a form from after that partnership tax return is filed to report that income on your personal tax return. Basis in the partnership can become an issue. I won't get too deep into that, but basically you have to keep track of what different partners are putting in and taking out of the business, because there can be tax consequences there if the numbers don't line up right. Some other considerations if you're thinking about having a partnership: this is not tax stuff. It's also not legal advice. I'm not a lawyer, right? But my personal opinion, really important to have a strong operating agreement so that all of your agreements between the partners are written down. If there's a disagreement, you have something you can look back to. I think it's really important to have a strong buy-sell agreement as well. What happens if one of the partners passes away, if one of the partners wants to retire, or just wants to be done and wants to sell out? It's important to have that all agreed upon before you get to that point, because it's easier to make the decisions on how that should work before you have someone saying, well, I am going to sell right now, so I want a really high valuation, and the person buying out doesn't, right? It's also important, again, to think about insurance, right? If something happens to one of the partners, do we have to find someone to replace them, and how much is that going to cost us? So maybe we should have some life insurance on that person so that the business can continue running. And then think about having someone in your corner where if there is a disagreement, they can talk through it with you. A lot of times attorneys will do this for you. A lot of times it's the attorney who drafts the operating agreement. If there's a disagreement, you go to that person and say, hey, will you help us kind of figure out which direction we should go here? So those are all things that should be thought about in a partnership. S corporations, they're not actually a legal entity. So that's I think an interesting piece. We have the difference here between legal entities and tax entities, right? An S corporation is a tax entity. It's not a legal entity. You can't have an attorney go and draft up S corporation documents. What you do is you legally create an LLC or a C corporation, and then you file with the IRS to say, hey, I want to be taxed as an S corporation. They can have up to 100 owners. It's a separate tax entity just like partnerships, so there's a separate tax return, again, due on March 15th. And that all flows through to the owner as well. So with an S corporation, if you own an S corporation, you're paying yourself wages, and you're getting the profits from the company as well. So all of it still winds up on your personal tax return, all of the profits from the company. It's just kind of split up a little bit differently. So what's the point of an S corporation, right? We're an LLC, we're filing as a sole proprietor. Why would we want to become an S corporation if all of the income still winds up on our tax return? Good question. I'm making myself laugh, sorry. So in order to understand why filing as an S corporation can be beneficial, I want to kind of go through a tax situation here. So these are based on the 2026 tax brackets for a single person. Big disclaimer here, this is not how taxes actually effectively work, but it's pretty close, and it illustrates my point. So let's say this single person is making $150,000 in a business they own. That's going to be split up among all the tax brackets. So we've got the standard deduction here, $16,100 in 2026. That's the amount that everyone gets tax-free. If you have itemized deductions, it might be higher than that, but we're just keeping it simple. Standard deduction, that amount is taxed at zero. Then you have the 10% tax bracket, $1,200 in taxes there. We've got the 12% tax bracket, the 22% tax bracket, and the 24% tax bracket. So one misconception is that, hey, I'm in the 24% tax bracket. Is all this 150 taxed at 24%? No, it's not. I'm sure a lot of people know that, but I come across that quite often, so just want to make that clear. You're taxed at the rate in each of these brackets for the amount that is in that bracket. These are not all of the tax brackets, right? They go up to 32, 35, and 37 above that. So that's important to understand as well, but 150 grand as a single person gets you to 24% tax bracket. So that all adds up to about $25,000 in ordinary income taxes paid to the federal government. Depending on your state, Wisconsin has a state income tax, so there are going to be state taxes as well. We're just talking federal right now. However, since you're self-employed, you also have the self-employment tax, which winds up being about $23,000. In reality, it's a little bit lower than that, but again, we're keeping things simple. 15.3%, where does that come from? If you are employed as an employee, you've probably seen on your pay stub 7.65% for FICA, or sometimes it's on there as OASDI. That is a flat payroll tax that goes to Social Security and Medicare programs. You pay that out of your paycheck, and your employer also pays 7.65%. So when you're self-employed, you're both the employer and the employee, so you pay both sides of it, adds up to 15.3. So really, as a self-employed person, the total tax here is almost $48,000. So that's almost a third of the $150,000 of profits here. Again, this is profits as a sole proprietor. So maybe the revenue was $250,000 and expenses were $100,000 to get us to $150,000 of profits. That's the number that matters as far as taxes go. So the benefit of an S corporation, we're going to stick with the same situation. We've got a single person making $150,000, but now instead of all of that being profit, we're going to split it into $60,000 of wages and $90,000 of profits. We're still going to have that same ordinary tax of about $25,000, but now we're only taxed with the self-employment tax on the $60,000 of wages. So instead of that $48,000 in taxes, we're at $34,000 roughly in taxes. Again, not exactly how it works. There are other deductions in place here. You're going to limit some deductions filing as an S corp, but that's where the savings comes from when filing as an S corp. So in this very simple situation, you can see that saves about $14,000 in taxes. Why doesn't everyone do this, right? And actually, let's go back a minute. Oh, too far. Okay. Why would I pay myself $60,000 and not $40,000, right? And pay even less in self-employment taxes? Why pay myself a wage at all, right? The IRS obviously knows the law, right? So they're saying, hey, if you are an S corporation and you work in the S corporation, you have to pay yourself a reasonable compensation. So you can't get away with not paying yourself anything. You have to pay yourself a reasonable compensation, and that's often based on market data, what other people make in similar roles. Working with an accountant, tax preparer, tax planner, someone like me can help you determine what your reasonable compensation level should be. Another thing about an S corporation, you have to track your basis, kind of like in a partnership. You can wind up with tax consequences if the numbers don't line up correctly with what you're putting into the business and what you're taking out of the business. It reduces your qualified business income deduction. So as a sole proprietor, that $150,000 of profit, you get a qualified business income deduction of 20% of that. So that's a $30,000 deduction. That affects that ordinary tax. As an S corp, you're limited to a 20% deduction on the profits of the S corp. So you're limiting that deduction. You're also paying less into the Social Security system, so that will impact your benefits in retirement. So if Social Security benefits are based on how much you pay in to the system, so if you limit how much you're paying into the system, you're going to limit how much you're going to get out of the system. Also creates an additional tax return and additional fees to accountants and financial planners. Someone told me that it had to be in the con column. I think it's a good thing personally, but that's just me. I'm a little bit biased there. So we're going to talk a little bit about bookkeeping basics. One of the first things that I tell every business owner is make sure you keep your business and personal accounts separate. This is bad when they overlap like that. This is, I don't know if anyone knew this, but business and personal accounts, they're actually circles. So, and when they overlap, it's bad. This is better, but this is how we want it to be, as far apart as possible. Of course, there are going to be times when you spend on business things out of your personal account and vice versa. It's important to keep track of those things, but we want to do our best to keep them separate. Some accounts that you should consider having as a business owner. So the ones that you really kind of need, a business checking, a business savings, business credit card is kind of optional, right? I think it's a really smart thing to have a business credit card for a few different reasons. One, it helps you understand what your cash flow needs to be, right? So instead of money coming directly out of your bank account every time you swipe your card, you swipe your card, you get a statement at the end of the month, and you know exactly how much needs to be in your account on the date that the balance is due. You can also get credit card points with a credit card, right? And it's important if you get a business credit card, get one that gives you points because you can use those points personally and it doesn't have a tax consequence. If you get cash back, it can have a tax consequence. So typically if we're getting a business credit card, we want to focus on one that gets us points. Everything else is optional. If you don't have an LLC, again, doesn't really matter. You can always get that down the road. As far as so if you don't have an LLC, you're probably not actually going to be able to open business accounts, but you can always just open a separate personal account and make it use it only for business, right? So even if you don't have an LLC set up, still keep everything separate. Some accounts that you should consider if you're growing really fast, a line of credit a lot of times can make sense so that if you have a cash crunch, you can continue to grow the business while you're waiting for maybe payments to come in, right? And then if you have the opposite problem, if you need to keep a lot of cash in the business, kind of an emergency fund for the business, a high yield savings account within the business can make sense so that you can make some interest on that money and keep it in a separate spot. And then there just was too much room on the screen, so I tossed a jack-o'-lantern there. Happy Halloween. Tracking deductions and expenses. Not everything is a write-off. Just because you think you need it for business doesn't necessarily mean that you can deduct it. And there are some different rules around this stuff. David on Schitt's Creek had a really hard time with that. I know it's a Seinfeld thing as well, so don't be mad at me if you're Seinfeld fans. So otherwise, deductions kind of baseline. Ordinary and necessary is the terminology that we need to remember. If other businesses like you buy this stuff for their business, it's an ordinary expense. It's not something completely random, and it's necessary to keep the business running. That's kind of the baseline for, okay, I can probably deduct this against my income then for the business. But there are some that are kind of strange. So sandwiches specifically, I'm just kidding, not sandwiches specifically, but meals, if you're traveling for work or if you're getting meals with whether it's networking or clients that you're getting meals with, it's a 50% deduction. So it's just something that's good to know. If you spend a lot on meals, only half of it is going to be deductible. The other half shows up as it's a business expense, right? But you don't get to deduct it on your tax return. Vehicles, you have an option there of taking actual expenses for your vehicle, depreciating the cost of the vehicle, keeping track of gas and keeping track of oil changes and tires and all that good stuff. Or you can use the simplified method, which is 70 cents per mile driven for business. Most small business owners take the mileage method because it's a lot simpler. If you take the actual method, you have to prorate all of the expenses between business use and personal use, so it can limit those deductions, and it just becomes a lot more difficult to track. If you are taking the mileage deduction, it's very important to keep a mileage log, because if you're ever audited, the IRS is going to want to see, hey, you took 12,000 miles as a deduction in 2025. Let's see all those trips. And what they want to see is the date that you went somewhere, how many miles you drove, and what you went there for. So important to have that. And then lastly, the home office expense. Kind of like the vehicle expense, you can take either the actual method or a simplified method. The actual method, it's going to prorate the square footage of your home office against your total house. you're going to keep track of utilities and taxes and mortgage interest, and you're going to depreciate your house a little bit, which can be really complicated too. The simplified method is just going to say we're going to give you $5 per square foot of your office, limited to 300 square feet. So if you have a big 300 square foot office in your house, you can get a $1,500 deduction on your tax return for the business use of your home office. One important thing to note on that, if you rent an office and you work out of an office that you rent, you can't also take the home office deduction. That, should go without saying, but, it's confusing sometimes. Okay, taxes. There's only one person in the room, but do you know why I have these 3 pictures up here? No? It's okay. It's my own little joke. Do you have an idea, Ray?
Well, I'm thinking like Jedi powers or something,
Ah.
but I don't know.
No, so the bill that passed this summer, some people call it the One Big Beautiful Bill. It's way too long for me, so I call it OB3. Anyone knows that OB1 times 3 would be OB3, right? So anyway, it's, again, something I do to make myself laugh a little bit. So we're going to talk about that new bill a little bit, some of the changes that happened this summer. So first, there are some additional deductions. Probably heard a lot about no tax on tips, no tax on overtime, no tax on Social Security. They kind of did the first 2. If you make tips, if you make overtime, there's a deduction to offset some of that depending on your income. The Social Security one didn't exactly go through, but what they did is they gave an additional deduction to seniors under a certain income. So if you're 65 or older, you can potentially get an extra deduction. And then some other things, like if you buy a vehicle made in the US, you can deduct some of that, some of the interest on the loan. So some stuff to make my life more complicated, basically, this spring. They also eliminated some credits, the EV tax credit, some other energy efficient home improvement credits. One big credit that's been talked about a lot is the premium tax credit, often known as Obamacare. I don't believe that was actually eliminated in this bill. I believe it was actually set to sunset, but they chose not to re-up it. So that's what the shutdown that just ended was kind of all about. Democrats saying, hey, we want to get back to the enhanced tax credit. Republicans saying, no, we don't want to do that. Just ended without any real changes on that. There are some changes to itemized deductions too. So if you itemize, starting in future years, you may not get to take as much for charitable deductions. And the other one is the state and local tax deduction as an itemized deduction. It was limited based on the 2017 law to $10,000 in any one year. And they increased that to $40,000. So if you pay a lot in state and local taxes, you may be able to deduct more on your federal return and pay less in federal taxes. All of it phases out with income. And then the last thing, most important for entrepreneurs, is they made the qualified business income deduction permanent. Now, everything in tax law, if they say permanent, it's permanent with air quotes, right? Because they can go in and change it later through an act of Congress. It's kind of what always happens every few years. But for now, it was going to phase out at the end of this year, but they decided to keep it in place. So that means that business profits will continue to get a 20% deduction. So if you make $100,000, you only pay tax on $80,000 of it. That's an oversimplification, as is a lot of this, right? It's a presentation. And the QBI deduction does phase out with higher incomes. There are ways to kind of keep it in place for some businesses, not all. But it's an important thing to understand as far as taxes go, working with your tax preparer to see if you need to be doing anything in order to make sure you're maximizing that deduction. Again, a little bit more detail on the premium tax credit stuff. So it started as a tax credit to cover the cost of insurance for people who made less than 400% of the poverty level. In the lower 48, why do we call it the lower 48? I think Hawaii is further south. But the 48, the poverty level for a single family household is a little over $15,000. So 400% of that, if you're single and don't have any kids, would be about $60,000. So if you made over that $60,000 limit, you wouldn't get any premium tax credit if you're on the marketplace for insurance. This doesn't affect people who have health insurance through work, just if you're going through the marketplace and getting tax credits. It was enhanced during COVID though. So they made it so that if you make over that 400% of the poverty limit, your maximum amount that you would pay for health insurance would be 8% of your income, roughly. And income is kind of a flexible term with this because they like to add and subtract different things to get to a different income number. That is the part that's going away. So for anyone making a little bit over the 400% of the federal poverty limit, that's where it creates an issue this coming year, where premiums might wind up going up quite a bit for those people. Regardless, this is something that if you're on the marketplace, you should really be talking to your tax preparer, tax planner, financial planner about this stuff, because especially now, you might wind up with a $10,000 to $20,000 swing in the spring, depending on your income level, and there are things that you can do to adjust that. So really important to be planning around it. That's the action point here. Talk with your tax person and your health insurance person so that you can coordinate what's happening there. The issue is a lot of times people go get their health insurance and they get the advanced premium tax credit, so they're not paying anything for health insurance. And then in the spring, they find out that their income was higher than they thought it was going to be, and they have to pay all that back. That creates a really big bill, and you know, stomach aches. People get really unhappy about that. Yeah, thought I had something else on that, but maybe it'll come up later. So, on the tax side of things, how do we be audit proof? Good English there. First of all, you want to make sure that you have clear books. So what I mean by that is we're keeping track of our transactions. That's one of the main reasons we want to have separate bank accounts for our business from our personal, because it's a lot easier at the end of the year to go back and print off the statements and say, okay, here are all the expenses and what they were, and put that all into a spreadsheet. A spreadsheet works just fine if you don't have a ton of transactions. If you have more transactions, it's time to start thinking about using at least some sort of software. There are a bunch out there. Wave is free. QuickBooks is a little bit more expensive. We use Patriot as a firm for a lot of our clients. But those softwares can kind of help you keep a little bit better track of everything. However, it's important to note that it is easy to kind of mess up your bookkeeping. So a lot of times it makes a lot of sense once you can afford it to hire a bookkeeper to help out. Make sure that you're staying on top of things. Another thing, keep a mileage log. Again, I mentioned back when we were talking about mileage, the IRS expects that you have a mileage log. Every time you sign your tax return, if you're taking a mileage deduction, you're saying, yes, I do have a written mileage log. If your tax preparer doesn't know that, then doesn't know that you don't, then they're probably going to let it go through. If they find out that you don't have a mileage log, I won't file a return with mileage if I know that there's not a mileage log. Because it's a really easy, if it's audited, you're losing that deduction and you're going to have penalties and interest now and all of the taxes that you would have paid anyway. So keep a mileage log, please. What a lot of people do is on a monthly basis or at the end of the year, they'll look at their calendar and say, okay, I drove this place this many miles to, like I drove quite a ways to get up here to do this presentation. So I'm gonna write down, even if I forget to write down, today, then when I'm doing my taxes, I'll go back and say, oh, that's right, on, I think it's November 13th, I went up to Eau Claire and I gave a presentation, I drove this many miles. And that's okay, it just does need to be written at some point. There are also apps that can help you with that. MileIQ is a really popular one. QuickBooks also has an app that tracks mileage. And then last thing, don't do fraud. It, again, kind of seems like it goes without saying, but When I hear people talk about like, hey, but what could I get away with? That's when we start to have an issue. It's like, yeah, I really don't want to play that game. Tax returns have a 3-year limit, so typically you're not going to get audited after 3 years. However, there is no statute of limitations on fraud. The IRS can go back however far they want to say, hey, we think that you did something illegal here and you owe us all this money, right? So we don't want to play that game. It's not worth it. There are plenty of legal strategies to lower your tax liability, so let's stick to those. All right, now we're going to talk about investing for the future. This is my favorite part. I like the financial planning aspect of things more than the accounting side of things. Keep in mind it's all hypothetical. We're going to talk about some numbers. Past performance doesn't guarantee future results, right? All that good stuff. But it's good stuff to keep in mind as you're saving for the future. So first, compound interest. People have a really hard time understanding compound interest. If we say, hey, I'm going to invest $10,000 and it's going to grow at $10,000 a year, in our mind, this flat line is kind of what's happening. So over 20 years, oh great, I have 30 grand. Tripled my money, that's pretty awesome. But really what's happening is it's compounding, and you have over double that over that amount of time if you're getting those annual 10% returns. Typically, it's going to look better than you think. You should know that even starting out with a small amount, that's okay. It'll be working for you, and you'll continue to add to it, and it'll turn out better than you think in the future, more than likely. It's also important to, if you have a long time horizon, take some risk by investing in stocks. If you're going to be spending money in the next couple of years, absolutely don't invest that money in the stock market, right? But if it's a long time horizon, stocks are the place to be. You can see that this is the percentage of times the stock market was positive over different time frames. So every day you have about a 50-50 chance. Look out to a year, about 75% of years the stock market is positive. Go out to 10 years, it's very rare that we have a 10-year period where there's a loss in the stock market, and 20 years it's never happened. This is the S&P 500. It's the 500 largest stocks in the United States that are profitable. So this isn't all stock markets, but it is a good representation of what we're investing in. So, account types to invest in. I'm going to kind of glaze over the first couple here, but CDs, bank accounts, and annuities. Most people are familiar with CDs and bank accounts, right? Just about everyone has one. It's all guaranteed up to the FDIC limits. And annuities are another way that you can invest with a little bit less risk. Sometimes they can also be pretty risky, but it just kind of depends. Non-retirement brokerage accounts is a type of account that people kind of forget about. I think a lot of people know I should invest in my 401k for the future, or I should invest in a retirement account for the future for the tax benefits. Non-retirement brokerage accounts are really nice because there aren't limits on how much you can put into the account, and there aren't limits on how much or when you can take money out of the account. So they're really flexible. You can invest in just about anything you want. And who's to say, I'm 28, so I might have some expenses 10 to 15 years out from now that I really want to invest for. But I can't really do that in my retirement accounts because in 10 to 15 years, I'm not going to be 59 and a half, which is how old you need to be to take money out of your retirement accounts without penalties. So a brokerage account is a great spot for me to kind of build up money for, buying something fun in the future. I don't know what that is yet, but we'll figure something fun out. Other types of accounts. So main two types of retirement accounts are Roth retirement accounts. Those are accounts that you put money into. You don't get a deduction when you do that, but it grows tax-free so that in retirement you can take the money out without paying any taxes. And pre-tax retirement accounts, you put the money in now, you get a deduction. So it's a way to lower your current year income. And then in retirement, when you take money out of it, you're going to wind up paying tax on those dollars that you withdraw. So there's a purpose for all of these different types of accounts. We're going to focus a little bit on retirement accounts because for business owners, there's a little bit more flexibility there. So These are the limits for tax year 2025, and they're limits for people who are under 50 years old. So things change, the limits adjust as years go on for inflation, and you also can put more in if you're retired. So the sort of, we did two. The sort of regular accounts here are just pre-tax IRA or Roth IRA. Anyone who has earned income can put money into an IRA. There are some income limits, so if you make too much money, you may not be able to put money into a Roth IRA directly. There are ways around that. You can work with a financial planner on that. There's a $7,000 contribution limit. You can do pre-tax or Roth. It's not tied to your business, so it's an individual retirement. It's not individual retirement account. It should be. Can't remember what it is, what the A stands for, but it's basically an individual retirement account. And then there are income limits that may apply, like I mentioned. A SEP IRA is really popular for solo entrepreneurs because you can put a lot more into it. So if you make a decent amount of money, a SEP IRA allows you to put 25% of your compensation. That'd be like 25% of your wages if you're an S corp. It's actually limited to closer to 20% of your profits if you're a sole proprietor. But then the overall limit is $70,000. So you can get, if you make $100,000, you'd be limited to $25,000, but it's a much higher limit than the $7,000 into the IRA. So it's a way to lower your income quite a bit. It is an employer plan, and the reason it's best for sole proprietors or people who don't have any employees is because if you have employees, it's a profit sharing plan. So you basically have to put money into your employees' accounts as well as your own accounts, often based on compensation. So if you make $100,000 and you have 3 employees who all make $50,000, and you want to put 10% into yours, you put $10,000 into your SEP IRA, and you're putting $5,000 into each of theirs. So you're giving $15,000 to your employees and you're keeping 10 for yourself. It's just not quite as efficient. Some employers want to be really generous that way, and that's awesome. But a lot of times employers want to be a little bit more flexible with those contributions. For small employers who have some employees, a simple IRA can be a good option. There's a $16,000 limit, so as a business owner or as an employee, you can put $16,000 into it. It's a matching plan, kind of like 401k. So if you put in 3% of your pay as an employee, employer matches often 3% of the pay. There's a little bit of flexibility there. It's pretty low cost to set up. You cannot have more than 100 employees. What's important to note is it's really not all that simple. It's actually gotten really, really complicated over the past few years. They keep on trying to make it better, but they want to give the benefits to smaller employers and not larger employers, so there are different rules based on how many employees you have. There is an option to add a Roth account, but that gets really complicated too. I don't do a lot of simple IRAs for that reason. Instead, for people who have employees, we're typically doing 401ks. Important to note that if you don't have any employees, you can set up a 401k for yourself. It's called a solo or an individual 401k. You can see the limit as an employee is $23,500. As the business owner, you can put $23,500 into it kind of as an employee. And that is limited to your compensation as well. So if you only make $20,000, you can only put $20,000 into it. But if you make, $50,000, you're not limited to 25% of compensation for that $23,500 limit. There's also a $70,000 total limit as an employer. So if you're self-employed, you put $23,500 into it, but you want to put more into it, then you can do basically profit sharing into the solo 401k. Very similar to a SEP. There are limits based on compensation, but it's a way to get a lot more into a retirement account for either more deductions or for more tax-free income in the future if you use the Roth. And then as an employer, it has very flexible match and profit sharing options. So simple IRA is pretty rigid. It's going to be a 3% match or 2% non-elective where the employees don't have to put money in for you to put 2% of their pay in. SEP, it's profit sharing across the board. 401k, you can do a match and profit sharing. You can choose not to do either one of those. So really flexible, great way to save more for retirement and save money on taxes. All right, so that's all I've got, but I want to leave with a little bit more about my company. You can see all of our services and pricing at our website, priestfp.com. There's a blog on the website if you want some more information. I think there are like 50 blog posts up there that I've posted. I'm going to try to do one monthly. So there's an email sign-up list. If you want to get my blog monthly, you can sign up there. You'll get notified every time I post a new one. And then you can follow me if you want some more frequent stuff. I post every day on Facebook and LinkedIn. So you can follow me on LinkedIn or on Facebook or on both. And then lastly, we are taking new clients. So if people are looking for bookkeepers, tax planners, tax preparers, or financial planners, then I forgot to mention, it's not just me. We've got a team of about 4 or 5 full-time people right now. So there are a lot of us on the team willing to help move things forward for you and your business. So that's my last little pitch there. Sorry about that. But that's all I've got. So yeah, time for some questions.
Okay.
I don't do a question slide because I think it's kind of,
Yeah, all good. Okay, so first question. It's great to know, let's see here, I'm gonna do my audio real quick.
Okay.
It's great to think about what ideal state is and to have it all tidied up and then hit the green go button. But that's not usually how life works.
Yeah.
And sometimes things get away from entrepreneurs and startups, and you can be a couple years in and realize that those circles are very overlapped
Yeah.
on accident, right? And
Yep.
you thought you knew better, but it just kind of happens that way. What advice would you give to someone who's maybe a couple of years in or even a year in and realizing, shoot, this has really gotten away from me and I need to get tidied up so that I don't end up in trouble?
Yeah. Yeah, so first, if you don't already have your bank accounts separated, that's step number 1 so that we can stop the bleeding, so to say, make it easier moving forward. Specifically, if maybe you're already there and everything is separate, but things are still kind of messed up in your books and you're not really sure how things should be working, you're starting to get letters from the IRS. At that point, it's time to call an advisor to help with. It's going to cost some money, but it's going to be worth it. If it's just a problem of, hey, I've been really crossing the business and personal boundary there, I tell everyone most banks will let you export a spreadsheet of your transactions. Do that and go through and highlight the business ones or highlight the personal ones, whatever is easier, so that you can start to get it organized so you're ready for tax season. But at the same time, go and separate the accounts so that, again, you don't continue to have that problem. Yeah.
Makes sense.
If you have any questions, raise your hand or just shout it out.
So then the next question here, I think a lot of entrepreneurs feel that they should be self-educated on all the things, first of all, and then second of all, definitely the financial and the taxes and things like that. But the reality is that unless you're someone like yourself whose business is this area of expertise, most entrepreneurs don't have that full understanding. Could you give some advice to navigating that, and specifically what degree of self-educating people should really try to do versus when it makes more sense to bring in an expert?
Yeah. I had a conversation with someone recently, and they said something like, I just feel like I should know more about this stuff. And I said to them, why should you know more? Who taught you this stuff? How are you supposed to know more about finances? It's not easy. We don't do a good job of teaching everybody about finance and accounting. There are resources out there, right? You want to make sure that you're following a good resource. If you're looking for a place to start, again, you can follow me, follow my blog. I try to put some information out there. at the point where if you've gotten to the point where you're behind, I think that's a sign that this isn't it isn't something that's worth spending your time on, right? Especially for business owners, there's almost always something that's more productive that you could be doing with your time than your books. We're really good at it. We're really efficient, so that's how we can make a profit off of it, but still save you more time than you're really spending money on. Especially if you're getting to the point where you can afford it, and it's not pay for a bookkeeper, pay for groceries, right? At that point, I think it almost always makes sense to engage someone who knows what they're doing. And if not on an ongoing basis, at least once in a while, just check in and say, hey, I've been doing things myself. Can I pay you for an hour or two to just review everything for me and make sure that I've got it right, you know? And then send me on my way. If I've got it wrong, maybe I'm gonna hire you, you know? Like that's the type of thing that I think is important to understand. From a tax perspective, almost every business owner, I think, should be having a professional prepare their tax return, because there are so many little things in there that make it a little bit more complicated. It is more expensive than just a single person or a married couple that has regular jobs getting their tax return filed, but almost always it's going to make sense to hire a professional.
That makes sense. So let's say we've got an entrepreneur who buys into that and they're like, yep, I want someone to call me for my expertise. I'm going to call a bookkeeper or a tax professional for their expertise.
Yeah.
But I still want to know enough to be aware of what questions I should be asking and just sort of aware enough to participate in the conversation.
Yeah.
You mentioned your blog, which is great.
Yeah.
Do you have any other recommendations for resources for people to just get that entry-level foundational knowledge?
Yeah. So most bookkeeping softwares, I know like QuickBooks has a course that I think anyone can take the bookkeeping course on QuickBooks. It's a little bit more geared towards like accountants and people who have a little bit of a background, but it could be a way to learn a little bit more. You know, there are all sorts of resources on YouTube. I'm connected with a bunch of people on LinkedIn that post a bunch of really insightful stuff, you know, so I think that's a great spot to just go try to learn a little bit. Yeah, and then if you are at that point of wanting to work with a professional, but you want to make sure that you're a part of the conversation and you know what's going on, it's really important to just interview a couple of professionals and find someone who will make sure that you're educated, I think, you know, because there are some professionals out there who just kind of want to get the work done and not necessarily have to explain a bunch of stuff to their clients. There are some clients out there who that's what they want, you know, like this is not my forte, you take care of it, I don't want to deal with it. But if you want someone who's going to be a little bit more foundational with you, then that's something you should interview for when you're looking for somebody.
Perfect. So then the next question we have here, I think one of the first things that entrepreneurs have sort of registered in their mind as a thing that they need to be aware of is the idea of quarterly tax payments.
Oh, yeah.
Could you talk about that a little bit and
Sure.
just help people understand what that phrase even means and how it
Yeah.
relates to small business taxes?
Yeah, I can't believe I didn't put that in here. That's a really good point. Yeah, so when you're an employee, typically you have withholding from your paycheck to pay your taxes. And then in the spring, you're either getting a refund or paying a little bit more in. As a business owner, you're no longer doing that withholding, and you have that self-employment tax to think about now. So it can be a bit more of a surprise. The IRS wants you to pay your taxes when you earn the money, basically. So that's why we have quarterly taxes. They say, hey, in the first quarterly, if you make $100,000, well, let's say you make $150,000 and you're going to owe that $48,000 in taxes. They're going to want you to pay $12,000 a quarter to avoid tax penalties in the spring. They're called underpayment penalties. So if you don't pay those tax payments, you're still going to pay the same amount in taxes, but you might have underpayment penalties. A lot of times estimated taxes, we don't know, especially as entrepreneurs, we don't know how much we're going to make in any given year. So the IRS has a safe harbor rule. As long as you pay in 100% of last year's tax liability, or 110% if your income is over a certain limit, through your quarterly taxes, then you're safe harbored. You're not going to wind up with underpayment interest on those payments. So typically that's what we're looking at, but tax planning throughout the year can also help you understand, how much am I going to owe? Should I be paying more in? Should I just keep the money to myself so that I can make a big payment, save for the payment in April? That type of thing is kind of what the throughout the year planning can help with.
Perfect. And from a logistical standpoint, would you recommend having a separate checking or savings account to set aside money along the way for those quarterly tax payments?
Yeah, I mean, some people do that. So, some people use what's called a profit first framework. So there's a whole book about it. I haven't read the book, and so I have kind of a medium understanding of the concept, but it's basically, this is what I want my profit to be. This is how much I'm going to owe in taxes. This is some people have a charitable giving portion there. And then this is how much I have left for my expenses to run my business. That's not how I operate. Those people have different accounts for each of those. You don't have to use the profit first framework to have separate accounts for specific payments, right? Sometimes it's helpful. Honestly, sometimes it overcomplicates things. So it kind of depends on your business and what works best for you. I always like to help people keep in mind that those quarterly estimates, those are personal taxes. It's not business taxes. It's not a business expense. So typically, if you are saving for taxes, I encourage people to do that in their personal accounts. But yeah, it's important to at least know what's coming up, and whether or not you have a separate account specifically for taxes, I think is kind of a personal decision,
Totally. So then, continuing that train of thought, it feels really simple in the beginning when you think, oh, I'm just going to open up a business checking account, and then I've got my 2 circles, and I'm going to file my LLC, so on and so forth, and okay, I'm ready. But then it starts to get complicated when things like, let's say Shopify e-commerce comes into play, or maybe someone's using a credit card for online purchases, and because that can be safer in some ways, but now you've got multiple accounts.
Yeah.
Even things like Venmo or PayPal, it just starts to get a little bit messy sometimes.
Yeah.
Do you have any advice or guidelines for people facing that particular challenge, and how to keep things straight, and maybe how to clean up a mess if they find themselves in one?
Yeah. So again, I think that's where bookkeeping software can come into play. Kind of help you keep track of all the transactions that are happening, and automate things as much as possible. Especially if you're getting into a situation where you have multiple accounts, there are multiple places that money's coming from. Maybe you have multiple services or products. So typically, that's whether it's Wave or QuickBooks or one of the other ones. That's probably the best way to deal with it, is to have a bookkeeping software.
Makes sense. Okay, next question that I'm seeing here is mileage versus a company vehicle. Now that might not be as relevant to a true very beginning entrepreneur, but talk us through what it looks like to get a company vehicle, and how that might compare to tracking your mileage.
Yeah. So again, they typically come out pretty close, right? The mileage deduction and the actual deduction, because the IRS has done the math to see, 70 cents a mile is about what it costs to run a vehicle, right? Now, there are some tax games you can play as far as deducting things faster if you buy a company vehicle. But you have to prorate it if there's any personal use. So if you're buying a company vehicle strictly for your company, a lot of times we are going to take the actual expenses instead of the mileage expenses, especially if you're maybe not driving a whole lot of miles, because there are more than deductions that you can get that way. But again, it's a very, very personal distinction. And there are some cases where, like if you have a bunch of vehicles for your business, you may be forced out of the mileage deduction and have to take the actual deductions. So It really is a case-by-case sort of situation, and it can make more sense to purchase a company vehicle if you file as an S corp or it's a separate entity, versus if you're a sole proprietorship. So, yeah, that really doesn't answer the question, but hopefully it provides a little bit more detail on, kind of what you're looking at there. When I do tax returns for people and that becomes a question, we're doing the calculation to see what the better deduction is for that person. And we're not just thinking about this year, we're thinking about future years as well. So that's a really important piece. You want to work with someone who's forward-looking and can help you actually do those comparisons to make sure you're getting the best case out of it.
Perfect. So this is a little bit of a different angle on things, but some of us have maybe heard horror stories of partnerships that have gone awry.
Yeah.
You spoke a little bit about this towards the beginning of your presentation. I'm just wondering if we could circle back to it and share some advice on, first of all, how to set yourself up for success from the beginning if you've got a partnership involved. And then second of all, if you are heading towards a potential parting of ways, what that might look like and what steps that you would need to take in order to protect yourself and protect the company.
Yeah. So I'm going to go broader than partnerships first, because I think that what a lot of entrepreneurs are thinking about when they start their business is making it through the next few weeks, And we should really challenge ourselves to think not only a little bit longer term, next couple of years, but also what's the exit plan? Do we plan on selling the business at some point? Are we hoping that an employee takes it over or maybe a kid takes it over? Or is it just going to dissolve at some point whenever we're done working? So that's a really important piece for any type of business. It becomes a little bit more important when there are other owners involved, right? So we have to kind of think about all of the potential exit plans. It might be retirement, it might be someone no longer can work for whatever reason. It might be I just no longer want to be doing this. You have to think about, in those cases, how would we determine the value of the company for a buyout, one way or the other? And if disagreements come up, how are we going to handle that? I don't say always often, but I would always get an attorney involved because they're going to come up with all of the things that you're not thinking could go wrong because you're excited. You have this partner, you're really good friends probably, and you're like, man, nothing could ever go wrong, right? But things do go wrong. Hopefully they never do. If they don't ever go wrong, it doesn't hurt to have paid a couple of grand to get a really good operating agreement in place. So that's the important part. They can help you think of the risks that you're not thinking of, and also the remedies that are common for different businesses when they experience one of those situations. So.
Perfect. All right. So now a totally different angle here again, but at the Hatch Pitch competition on Tuesday of this week, there was a contender who talked about his desire to eventually become a B Corp.
Oh.
And so I'm wondering, going back to the entities that you laid out, could you explain what a B Corp is and how it may be different or the same as a nonprofit?
Ooh. Yeah, I'm not super well versed in B Corps, but here's what I think I know. I believe that most B Corps are actually C Corps from a legal and tax perspective. You'll see like public companies that say this is a certified B Corp on their label. I believe it's more of a we're making things better for the world, hitting certain metrics in order to say, hey, we're a B Corp, partly for sort of a marketing piece. I always feel better when I buy something that says it's a certified B Corp, right? And also I'm guessing there are probably some tax benefits to it too, but again, not a clue. So I'm not a good person to ask about that. That's kind of what I think is going on there though.
Okay, well that's great. All right, and so then this is the last question that I've made note of here. Going back up to 100,000 foot view, let's pretend here that we're working with someone who has wanted to become an entrepreneur for a long time. They've got this dream of a business. They're ready to make the leap. What are the first 3 to 5 things that they should do to do it the right way from a tax and financial standpoint?
Yeah. Personal budget is for sure number one. You need to understand how much runway you need. Sometimes things happen faster than expected, right? But when I started my business, I was thinking about it ahead of time. I figured out how much my wife and I were spending on just our daily living, and without my paycheck, what the difference was going to be. And for me, I wanted 2 years of, if I don't make any money for 2 years, we're going to be okay. Obviously not great. Thankfully, that's not what happened. It's been about 2 years now. So that's number one. I would say number 2 is to think about ideally where you want the business to be 5 to 10 years out. Draft a business plan. That's something that a lot of people don't do. And if you look at success and failure rates of businesses, the success rate is a lot higher for business owners who drafted a business plan before they started their business. We have great resources in the state of Wisconsin. There's the Small Business Development Center at every UW campus. So utilize those, they're free. You can go and talk to really smart people about helping you draft a business plan. Really important thing to do. And then it kind of shifts, are you based on what kind of business you're starting? I run a service company. There's not a whole lot of overhead cost, right? It's just my time, some of the tools that I use. So it was pretty easy for me to figure out, based on how much time I have each week, how much time I want to spend working and serving clients, how many clients do I want to target having, and how much do I need to charge in order to make that happen? Does that align with market rates? So that's kind of how I determined what my business started to need to look like. And for a service business like this, a lot of times you can just save up and get started. You don't need to go talk to a banker about getting a loan. If you're looking at a like manufacturing or maybe a retail sort of business, you need to go talk to a banker and start to figure out what your options are, what types of loans are available for you, and they will be able to provide more insight on the things that you should be thinking about financially for your business before it even gets off the ground. Again, I know in Eau Claire there are a lot of great bankers around here, so no shortage of options to go talk to people. There are also community resources. I think the Regional Business Fund is one of them. I think there are others. I'm not 100% sure, but so talk to people in the community that can help you figure that stuff out and help you get to a point where you feel comfortable starting your business and being able to grow your business. I think that's 3. I don't have 5.
Perfect. All right. Well, can't thank you enough, Austin, for doing this. I think that's a wrap. Any closing comments or anything that you'd like to share?
Only thing is, if you ever have any questions, feel free to use me as a resource. Go to my website and reach out. Go to LinkedIn and reach out. Whatever works. Always happy to have a conversation. Whether you wind up working with me or someone else or not working with anyone at all, if I can help, I'm happy to.
Amazing.